Prices are going up forever, especially the things you want and need the most. And they're going up because you're being robbed right now, and you might not even know it. People are working harder than ever just to stay in place, sometimes juggling multiple jobs and still scraping by. And here's the unfortunate truth. This isn't temporary, and it's not slowing down. It might even accelerate. Homes across the US are up over 50% in the last 5 years. That $4 coffee is now closer to $6. Groceries, rent, insurance, everything feels noticeably more expensive. This isn't a mistake, it's a policy. Let me show you how it works and why it will never stop. Let's say 5 years ago, a house was $500,000, and today, it's $750,000. It didn't get bigger, it didn't get fancier. So why does it cost 50% more money? It's because the dollar, the pricing unit, got weaker, not because the house got better. When the money we price things in loses value, the prices of things go up, especially scarce assets like houses, gold, or fine art. This is what economists call inflation. In 1970, the median home sale price in the US was $23,000. Today it's over $400,000, 17 times more for roughly the same house. And 1 ounce of gold surged from $35 to $4,500 today. A gold bar didn't get 128 times better. It's still just a gold bar. The dollar simply collapsed in value relative to gold. But money losing value isn't random, it's predictable, and it's not going to stop. And there's a chart that explains it all. This is the M2 money supply, the broad measure of dollars in circulation and in everyday bank accounts. In 1970, the money supply was $589 billion. As of early 2026, it's $22.7 trillion. That's a 38 times increase in 56 years, about 6.7% money supply growth per year. When the supply of something multiplies this fast, its value gets destroyed unless demand rises even faster. But why is this happening? Why is the government always printing money? The US government is currently $39 trillion in debt. Just paying the interest on that debt now costs more than $1 trillion each year, more than the entire defense budget. And the debt is expected to grow by another $2 trillion in 2026 alone. There are only 3 ways out of this. The first option is to raise taxes, but that's immediately painful for everyone. People are already struggling. Telling them you're taking more of their income isn't a popular strategy. The second option is to cut spending, which sounds reasonable until you ask what programs get less funding. The third option is to print money. Printing is easy. It takes the click of a button, has no immediate cost, making it the easiest path to solve money problems. And it flies under the radar of most people, since the side effect, a weaker currency, typically plays out over a long period of time. This is why money supply inflation is often called a stealth tax, but it gets even more unfair. Simply printing money and holding it in an account doesn't cause inflation by itself. Inflation happens when that new money is spent into the economy. The people closest to the printer benefit the most. Whoever is closest to that new money has an advantage. They can spend it at today's prices, before prices have risen. Imagine you could print unlimited money at your house. You get to buy houses, cars, and stocks at current prices. But all of this spending would help push prices higher. By the time the new money trickles down to the masses, prices would be much higher than when the printing started. So how do you protect yourself from this? We've established that the US dollar supply has grown at 6.7% per year since 1970. That number is your real hurdle rate. You can't beat money printing with a savings account. As of this recording, high-yield savings accounts are paying around 4% annually, and 30-year US Treasuries are yielding about 5%. These help offset most of the stated inflation with very low risk. Another low-risk investment that actually pays relative to inflation is TIPS, Treasury Inflation Protected Securities. These pay the current consumer price index, or CPI, plus a fixed yield. Right now, 30-year TIPS are offering around 2.8% over CPI. If inflation is 3.8%, you're earning roughly 6.6%. And if CPI really spikes to 10%, your TIPS would automatically adjust to pay 12.8%. That's real protection. But if you really want to beat inflation, you have to own assets that come with higher levels of risk. The first is a house. Historically, this has been one of the strongest moves you can make, especially in desirable areas, because these homes tend to outpace inflation. Even though prices and mortgage rates are high right now, at over 6%, buying a home with a mortgage is still a mathematically strong trade. Here's why. You borrow dollars at a fixed rate, and those dollars lose value over time. You're paying off the loan with weaker dollars in the future. At the same time, you own a scarce asset that tends to appreciate as more dollars chase limited housing supply. The math works in your favor on both sides of the trade. For example, a $500,000 house growing at 5% per year becomes worth about $2.16 million in 30 years. At 7% annual appreciation, it grows to roughly $3.8 million. Meanwhile, your mortgage interest rate is fixed. It doesn't compound against you. On a $400,000 30-year loan, at 6%, you'd pay about $460,000 in interest. Even at today's higher mortgage rates, the long-term leverage still heavily favors the homeowner. Yes, the monthly payments are painful compared to a few years ago, but over multiple decades, the compounding growth on the home crushes the fixed cost of the debt. And the best part, it's inflation protection you get to live in. The second asset to own is stocks, specifically broad index funds like the S&P 500 or the Nasdaq 100. SPY gives you ownership in 500 of the largest companies in the US, while QQQ consists of 100 companies, mostly concentrated in technology. Historically, these have been excellent performers. Since 2000, SPY and QQQ both grew over 8% per year. But since 2020, SPY has returned roughly 15% per year, and QQQ has delivered about 21% per year. The next assets to consider are gold and Bitcoin. Since 2020, gold has returned around 18% per year, while Bitcoin returned 45% a year. But why have they had such strong performance? They both have low supply growth and rising demand. Gold's supply grows only about 1.5% per year, and Bitcoin is even scarcer. Its supply is capped at 21 million coins. Over 20 million coins are already mined, and the remaining 1 million will enter circulation over the next 100 years. Both are long-term stores of value and seen as excellent protection against the long-term currency devaluation we're talking about. So remember this: the dollar and every government currency around the world has no cost of creation and no supply limits. Governments will keep increasing the supply, which devalues the currency and pushes the prices of scarce and desirable assets higher forever. And there's no sign that's going to stop anytime soon. The losing long-term strategy is staying heavy in cash and currency. And the winning strategy is owning scarce, desirable assets. The math has been the same for decades, and there's no reason to believe the future will be different.